Hi, everybody. I want to talk today about a serious topic, which is about retirement and investing for that retirement. Because the goal is for one day for us to retire and have enough money in that nest egg to sustain us to however days we have left to live. But it's not even just about that. We want to have enough money so that we can enjoy our retirement age. So you want to travel. I mean, you want to move someplace else. Who knows? I don't know what your plans are, but we all have them, and we need to have the money to do that. But we also have to think about what happens if our health starts deteriorating. What if we need to pay for somebody to watch us? What if we need long-term care? Things like that are things you need to plan for. So it's not just about investing and making money for every day or something that you're looking 6 months in advance. We're looking for now 20, 30, 40, 50 years, 60 years in advance. And I used to do this as a financial advisor. I'd have people come in and they would tell me that they wanted to invest, but their idea of investing was more about they want to buy a house, they want to do this. And I would say, so where's your retirement? Oh, we don't have that. We're not going to worry about that yet. We're going to worry about that later. I said, well, then I can't work with you. And it's not that I was pushing mutual funds or anything like that. I just said to them, it's just not a responsible way to be. You really need to look about long term, and then we can work our way back and to see, yes, you want to buy that house, you want to do this, you want to do that, that's great. But we have to think about the long term gain. And they would actually pause and say, you know what, that's a really good idea. All right, well, let's figure out how to do that, right? So this is what I would say to them. Now that you want to retire, how are we going to put this money together? So the IRS, I looked it up, and right now it's if you're 50 and above, you can put $7,000, and I'm just going to use that amount just as, let's just say, right? If you're under 50, it's less. But even if you're above 50 and, God forbid, you're just starting to put money into the retirement, how many stocks can you really buy for $7,000? Because the idea is to have a pie chart, right, of stocks that will get you through the good times and the bad. Right now in our economy, we see that gold, is something, a commodity that people really haven't thought about in I don't know how many years, and all of a sudden it's going up because of the instability of our world that we're living in. Oil is another one, right? But then we have other times that it's completely opposite. So we need to have a portfolio that's well diversified to be able to sustain the good and the bad, right? So just as an idea of what to have, you have technology, your financials, consumer cyclicals. Well, those are the stable ones, right? We have communications, healthcare, industrials, consumer defense, energy, utilities, real estate, basic materials, and then you also want to have your bonds, right? Something safe to have in that portfolio. It's like, great, it all sounds great, sign me up. But how many can you really buy with $7,000? If we take a look at Tesla, it's $300. So how many shares are you going to be able to buy of that? And we're going to want to buy a little bit of everything. So my way, again, not financial advice, but this is what I would do if I had to start all over again. I would start with leaps. I would buy some leaps for January 2027. And I would say, all right, we have $7,000. I'm going to look to see where everybody else is at with this. I see somebody here is at 650. It's actually very possible if we get that push into the market that we're getting close to making all-time highs, right? In order to invest, you would wait for a little bit of a dip, but let's just say we're going to do this now, right? So let's say it's 7,000. I would try to go maybe one or two out of the money, strikes out of the money, because the idea is with these leaps, we're going to want them to act like they are the shares. In order to act like they are the shares, we need the delta to be 70 or above, right? So it's 60. It had open interest there, so there's other people in that. I would consider this one at 6,000. We'll see if we can get it for 6,400. I would start with something like that, all right, to to get it going, right? So then as time goes by, 2027 rolls in, about 6 months before this expires, I would then say, all right, I'm going to roll it out to 2029 now, right? So hopefully you made enough money off of this, and this is now in the money, so that you can roll it and to basically close it, and you're going to buy a new position, whatever the gain that is. Hopefully there's enough gain that we can use that money now in addition to the next year's, or the next year's 7,000, because now it's been 2 years, money that we can now buy more leaps on other companies, right? So each year we're going to try to buy a leap on other companies, or we can do this SPY, we can do like the semiconductors, we can do one for the financials, and build that little portfolio and have it grow, and eventually you'll be able to buy shares. Or if you wanted to continue with these leaps, I don't know if I would do that necessarily, but I'm just thinking of ways that you can get this going, because with the way that the market is moving these days, it's just moving so quickly that you want to take advantage of it. So let's look at SPY real quick. All right, so another thing that you can do as you're putting money, if you want to put it in little by little, is if let's say you have money in there already, and you're thinking now, I already have my portfolio ready. I've been investing every year, and I do want to add more in, but I don't know how to invest. When do I add in? Should I wait every year as I'm doing my taxes and just buy? Should I buy a little bit each month? Or, which is the better way? The better way, that there have been studies on this, is to buy systematically, whether you're going to do it monthly or bi-weekly or whatever you're doing, systematically just keep buying, because we don't know when we're going to have these downturns, right? Or upturns. Are we buying at the top? Who knows? We won't know unless, time goes by. We'll know where we're at and where it falls in the whole scheme of things. But if you do see something dropping, and this is when people are getting scared, that is when you should actually, if you could, double up that month and start buying more and more and more, because the person that buys extra as it's dropping is the one that's eventually going to make the most money. The person that stops buying and gets scared is not going to make as much, and the person that systematically is investing their money, they'll make money also, but not as much as the person that is investing double the money as this is going down, right? So it happens, and those are the times that we wait for in the market to make money. So another way too, to look to see, is the market, has it come down enough? We're just going to do this. I'm looking at the daily. You could do it the daily, or you can actually do it for the 3-year, just so you have an idea. And you can say, all right, well, this is the high, and this is the low right here. I'm just going to ballpark it right here. There it is. And here's the high. There it is. So that's the low, that's the high. As the market is dropping, you look to say, hey, using the fib levels, this seems to be a very important point. I may add a little bit more here. All right, let's see if it keeps going down, but I'm going to buy double here. Let's see. And then I hit this part, the 38. Oh, okay, I'm going to get a little bit more aggressive because it's coming down. As it comes down here to the 50%, you should have been adding even more aggressively, because 50%, I mean, that's a major discount that you're getting there. So that's the idea and how I would go about it to add money as we go. All right, so now we're going to look here. We're going to say, all right, am I buying in each of these little areas that is going to make my portfolio grow? Do I have enough, right? Because we do need to rebalance it. And you'll be able to go online too to find these portfolios and how you should be putting your money in at certain ages. Because when you're younger, you really maybe need 5% in bonds, if that, right? Because you want to be aggressive. As you hit your 30s, you maybe want to do more 10% of bonds. As you get older, we're going to have more and more bonds and treasuries and things like that because it's more secure. That's the idea, because we put all this money in, we want to keep that money that we've been adding, right? That's the idea of it. Now, if you have extra money and you do want to play with the market, that's fine. But first, you have to have this retirement. And I'm sure you heard this before, but it's just my way of reminding you, have your retirement buckets filled. Have them ready, and then if you have extra, that's when you play with the market, all right? I'm going to do another video on this, so look out, and if you have any questions, please let me know. Have a great day. Bye-bye.